everybody. Today we'll start with second lesson. The chapter's name is savings. What do you understand by savings? Savings means what? The action of putting money aside for use at a later time are referred as savings. Means you put a small amount of money aside and you don't use them regularly, and that is known as savings. Will you be saving money on a regular basis? See, you should normally save money on a regular basis. Starting out can be challenging for many people, but once you have an understanding of the benefits, it must be similar. See, savings nowadays is very much important. You should save regularly and every day. You should never miss that without savings. You should never miss savings. Always save money for your future financial security. The establishment of financial buffer is one of the primary benefits that comes from saving money. The financial buffer means the financial funds is one of the primary benefits that comes from saving money. The emergency you get comes from the money you save, basically. In the long run, your savings have the potential. In long run, savings have the potential to grow and be put achieving your goals such as purchasing home, going on vacation, etc. Means when you save money, what happens? You save it for long term. You can use this money to grow, to achieve your goal, financial goal, such as you want to purchase a house, you want to go for a vacation, or you want to pay for education, etc. Whatever. Suppose if you want to save, I can give an example. Suppose if you want to save, you save 500 rupees every month for 10 years. You could end up paying more than 60,000, and that's before the factor in interest. How much money could you put away if you started saving right now? Basically, they're trying to say that if every day or every month, if you save some amount of money, after a certain point of time, that money collects and becomes a huge amount of money. So this type of money can be used anywhere and anytime. Then you have savings account. Types of savings account. What is savings account? Types. See, now savings account means what? It's basically an account. You open in a bank, you go to a bank, you open an account, and where you deposit small amount of money into that account and gives you interest. You earn interest and you can use that money whenever you require. It's basically you're putting money aside in the bank. Okay, now let's learn the types of savings account. You have regular savings account. First is what? Having regular savings account. The most prevalent kind of savings account is a regular savings account. The most useful or very oldest, you can say, which prevails during nowadays, is the regular savings account. Banks and other financial institutions provide them. Who provides them? Banks and other financial institutions. What do? They open the account, and upkeep this account is simple. They open an account and maintaining this account is simple. What are the features of this and benefits of using this type of accounts? See, first of all, it becomes an easy deposit and withdrawals. You can deposit anytime, you can withdraw anytime whenever you require. Access to funds anytime through ATM. Suppose during non-banking hours, you need funds. So how do you how do you remove funds? Because banks are closed in non-working hours. So you go to ATM and withdraw money from there. So this is what an easy access to funds. This is open in 24 hours. Then you have online banking for convenience. Means that when you want money, you can have even online banking. You don't need to go to the bank branch and go do the transaction. Then you have no minimum balance requirement. Means that whenever you want to open a savings account, you have to have, you don't need to have any minimum balance requirement. Minimum balance means some amount of money that it should be there in the account. It helps financial discipline. Means that savings account helps to build your financial discipline. Means that you restrict yourself from spending unnecessary items. Liquidity allows for quick access to money. Means that when you start saving in a regular savings account, liquidity increases day by day, and it allows you to have a quick access to the money. See, for small savings and every transaction, regular savings account are the best option. If you want to save every day, then I would suggest this regular savings account is the best option. In this, you get different banks offer different interest rates on these savings accounts. There is usually very less minimum saving rate of interest, like 3%, 4%. Some banks provide 5% or more than 5% annually. Majority banks provide between 3 to 5% annually, but not more than 5%. Then second type of deposit, like savings account, is fixed deposit. In India, fixed deposits, or sometimes we call as FD. They're again a very common way to save money. They let you put money down at set interest rate, means at a predetermined amount of time. Means that suppose you have a large amount of money. Suppose you have 1 lakh rupees. What do? You invest this full 1 lakh rupees in an FD and for 1 year. In this, your money is blocked for 1 year. You cannot use this money, and you will earn a high rate of interest as compared to savings account. See, this is again a beneficial for your savings account. Benefits of what? You have guaranteed returns on investments. You know that after 1 year, I will earn 6%, 7% of interest. So you can calculate on a principal amount you have invested, and accordingly you know your returns. Low risk compared to other investments means that this type of investment is lower risk, has lower risk as compared to other type of investment. Because why? Because you know that after 1 year I will get this amount along with the interest. So there is less risk of losing this income. Higher interest rates and regular savings account means that FDs, fixed deposit, provide you higher rate of interest as compared to savings account. Monthly or quarterly interest payout available. One of the you can say benefit of having an FD is that if you want to have a regular income, then what you can do, you can give an option to the bank and say that I want a interest payout available. It can be monthly or it can be quarterly. And this type of savings is very ideal for education. When you need money for education, this type of saving is much more, preferential. Then you have is at maturity. Now, once you invest in this FD for 1 year, suppose for 1 year, then what happens after 1 year? At maturity means that after 1 year, when the time period is over of your investment, the bank gives you interest. What will the bank do? Bank will give you interest at the rate mentioned at the time of issuing the FD. And this type of FD will release this amount along with the interest to your account. Penalty and lock-in periods. See, FDs are lock-in periods, means that it is locked for suppose 1 year, locked for 1 year, 2 year, 3 year, depending upon your type of objectives. Then during the period, you cannot withdraw. But if you want money emergently or urgently, you can withdraw during that period, but they will charge you penalty. So to avoid penalty, you should avoid withdrawing this money during the time period. See, second type of savings account is recurring deposit. This type of deposit again is for savings. The only difference is that you in FD and recurring, the only difference is that in FD you invest a lump sum amount together in an account, but in recurring you deposit some small or nominal account every month. It's intended for savings. You set aside a certain amount of money each month in this account, and those who have stable income, like those who know that I'm going to earn suppose 50,000 per month, I can assure that out of 50 I can put 1,000 every month in recurring deposit, so that every month if I put 1,000, at the end of the year I will have 12,000, and on that I will earn interest. So then you're saving a small amount of your income in this account. So this is again one of the different type of savings account. Then what are the features and features? Features, you can say that you can set up regular deposit period amount with RD. Means you can give a instruction to the bank that please please withdraw 1,000 rupees from my account and deposit in an RD account. It's a predetermined amount. Means you've already decided before installment, before depositing into the account, that this much of amount, X amount has to be deposited into the RD from your account. It's consistent monthly contribution, means that this type of contribution monthly is consistent. There will be no breakup, there will be no stoppage, nothing. Once you give the command, it is consistent every month. The minimum period varies from 6 months to 10 months, 10 years. Means that this type of account varies from minimum 6 months to 10 years. You can open an account for between 6 months. For 6 months, you can say for 1 year, for 2 years, but maximum 10 years. Now, comparable interest rates to those FDs. You can see that the rate of interest in FDs and RD is different. See, establishing this type of RD provides a disciplined savings routine. Means you have to invest 1,000 rupees every month into RD. It's a disciplined routine savings. It assesses the gradual assembling of scalable corpus. Means that slowly and gradually, this will assemble your money and build a good corpus. Okay, then you have is what high interest savings account. In this type of, then you have fourth point type of savings account is high interest savings account. Saving account with higher interest are preferable choice. Means that in today's world, if you want to save, what will you do? You will choose that type of account which gives you high rate of interest. You will not choose an account which gives you like 2%, 3%. You will choose those type of account which will give you 6 to 7% interest. See, you have variation from standard savings account. The interest rates are where the main difference are found. Means that in these type of accounts, you find a difference is that the rate of interest. The rate of interest normally range from 6 to 7% annually. They might be they might, however, require minimum balance. If you want to go, see, when you want to go for a higher rate of interest, you will find some advantages, you will find some disadvantages. See, when you want to, when you want to earn a higher rate of interest, you have to also, bear the disadvantages. That, see, you have to maintain a greater minimum balance requirement. See, in earlier, you don't need to maintain, but now you have to maintain a minimum balance requirement if you want to earn a higher rate of interest. Then you can say that high interest account uses when. See, when can you use a high interest account? When it is perfect for creating safety net of savings, best value for money you don't need right now. Means you don't need the funds right now, but you are creating a value for money in future. Ideal for emergency savings for particular objectives. This type of money is used when an emergency has occurred, or any for particular objectives, like for education, for marriage, etc. Before selecting, compare the terms and conditions. Before you want to go for the savings, you have to compare the terms and conditions with every other type of investments. Verify that you are aware of the withdrawal restrictions. You have to verify that. Suppose, okay, you have invested it. Also, you should know that is there any withdrawal restrictions or not? And if there is, how many withdrawals you can do in a month or in a week? And if above that, then are there any charges or penalties? Then you have importance of early savings. Again, saving money at an early age grows over time. Saving money from an early age allows to grow over time. Interest rates increases with an early start time. Okay, like once you start, when you are around in 20, suppose if you are in 20s age, you have to start saving from now. Once you are 20 to or mid 20s, start saving from that time till the age you become 40s. You have a lot of money in your corporate because once you start savings, you keep on saving, and on that your money start growing. And once the money starts growing, your money is compoundedly growing, and through this, after some point of time, you have a good amount of corpus collected. Now I can tell you, see, once you know your interest is compounded on your investments, so they are best describe significance of savings. You have why you need a quick early investments or savings. It gives you first is financial security, means that again if you have an early savings, it provides safety net for unexpected expenses. Unexpected expenses may occur through this. If you have any unexpected expenses, you have, yes, I have a security, financial security made, so I can use that. You can use a goal achievement, means that you're achieving your goal is long term or short term, you're achieving it accordingly, and you're using this money for buying any home or for education purpose. Retirement funds means that you are saving this amount for your retirement once you retire, because after retirement you have you're less likely to have regular income, so you can use this money for retirement. Lowers financial stress, means I know in today's world everybody has financial stress. Like today we are earning, what about tomorrow, what about the next 5 years, because the market out here is not that going well. If so, this what happens. Once you start saving, you have your stress becomes less. Opportunity for riskier investments. Once you start saving, you can have an opportunity. You can go for investments which are risky, you know, and those who are risky investments have a better, have give you more growth on that. Then you have inflation protection. Means what? See, everyday inflation is increasing and increasing. But today, once you start saving, your inflation, you can protect your money that you can survive in this high inflation also. Then you have freedom to explore. Means that once you I know you're financially stable, everything you can pursue your dreams and passion without stress. You can basically just enjoy your life and achieve your dreams. I hope you understood why saving is much more required in today's life. So now, those who have not started saving, please start saving so that it will be very helpful for you in your later period. Now, I would explain about benefits of saving. This is again the similar terms and everything is explained what are the benefits. Key benefits you can say is compounding growth. Once you start saving early, your money starts growing with compounding interest. Because more the time you invest, the more compounding interest you earn. Okay, and it is both returns are both for initial investments and accumulated interest. Then again, it helps for financial security. It builds again. You can say when you start early saving, your financial security increases, and once it increases, it is used. It sometimes it you have an unexpected expenses. Life is unpredictable. You need some money for emergencies. Saving provides a cushion during job loss. Means that once you sometimes during recession and everything, employees are being laid off from the companies, and during the layoff, you don't find easily the new job. So during the layoff period or during the layoff period, you can use this type of money during this period. Then you achieve long-term goals. Early savings helps you with future purchases, like a house. If you want to purchase a house or you want to purchase a car, you can use this type of money for your achieving your goal, long-term goals. Again, it lowers the financial stresses, retirement planning, and gives you more investment opportunities. Then you can, it also helps in better money management. Once you know that you have been you are started early saving, you're financially disciplined from as early as you can save. It teaches you how to manage your money in a good way. Prioritize your spending, prioritize your income. You can reduce your spending, become conscious of your financial goals and choices. This discipline will serve you throughout your financial life. Then you have freedom to take risk. Means that once you know you have your income, you have your financial stability, you have the capability of taking risk. Because risk sometimes gives you a higher return. Sometimes, not sometimes, can say risk gives you higher return. So you are capable of taking risk because you know in the back of your mind, I have money, I can take risk. If the risk doesn't suit me or this risk goes in a bad direction, I can bear the risk. Can say. Beat the inflation. Again, early saving means that your money has time to grow beyond the inflation rates. So you can even survive during high inflation rates through early saving. Then you have increased wealth accumulation. Means that once you start early saving, your wealth increases, accumulates, builds. This is again a good benefit. Avoid debt. Means that early savings, when you start saving early, you you reduce the need for borrowing in emergency because you have funds, so why will you borrow? So your debt also reduces. Flexibility in careers. See, once you know you're financially stable, you're financially free, you have freedom of financials, then you can have a flexibility in career. You can switch jobs, you can start a business. You don't feel that I don't have money, I'm jobless or due to financial constraints. This freedom offers more control over your path and life choices. Then you have education funding. See, once you start saving early, you have money for education, for your postgraduate, your masters, and everything. You don't need to have burden from your parents that I need money for education, etc. Peace of mind. Once you know you're financially stable, you have a good peace of mind, and financial backing reduces anxiety, etc. Then by better lifestyle choices. Providing flexibility in spending and lifestyle decisions means that once you know you're financially stable, you have a better lifestyle. You can choose your lifestyle as per your needs. You don't need to, you know, curb your your choices. You don't need to wants, needs, etc. You can do whatever you want to do. Then you have a certain saving goals. Now you can once you started saving early savings, started doing early saving, you can start. Then you know what are your goals. Set your saving goals and everything. So once you do that, it depends upon your goals, what you want, on your needs. It depends. You can wish for short term, medium term, or long term. Now then you have budgeting for savings. Budgeting for savings is what? Means that once you started saving, you have to prepare a budget. Means that how much will you save, where will you save, and for how long will you save. This type of budgeting will help you to increase your know where your money is going today and in future where will you get your money. your income. So, and you have to even also know that where you need to spend your life for your lifestyle, your needs. You have to fulfill even your needs, your wants, and everything. So, accordingly, you have to prepare a budget. And in the end of the month, how much money are you left with it? So, accordingly, you can use this money for next month savings, or next month spending, etc. So, savings, but before doing any savings, you have to prepare a budget. Today, I hope you understood about the savings, because savings is very much important. The rest of this I will continue in the next lecture. I hope you understood. If you have any question or query, please comment, and please do like our video. Please like, share, and subscribe. Thank you.